amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
It even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman, that's Chaz Louder, and this is A Steward's View. So glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Now let's take a look at what happened last week. U.S. equity indexes managed uneven results as investors monitored the escalating Israel-Iran conflict along with the Federal Reserve's latest decision on interest rates. The NASDAQ Composite and Russell 2000 indices rose less than 0.5%, while the S&P 500 fell marginally. S&P 500 sector returns were also mixed, with no standouts among the winners, and healthcare slipped 2.5%. Technology, meanwhile, faded into the weekend after a report surfaced that the U.S. is considering terminating waivers that allow some chip makers to ship to China. Crude oil prices ended higher by 1% in volatile trading, giving up earlier gains after the White House indicated it would allow time for a diplomatic solution before entering into the Middle Eastern fray. Gold futures slid 2%, while Bitcoin fell the same amount despite Senate passage of the Genius Act. That act is a regulatory framework for stablecoins that could promote wider cryptocurrency usage. Meanwhile, U.S. Treasuries eased after the Fed unanimously voted to keep interest rates steady but signaled that rate cuts are still likely later this year. In its updated economic projections and dot plots, the FOMC anticipates lower rates by 50 basis points, that's 0.5%, by year-end 2025, and forecasting slower GDP growth with higher inflation. Chairman Powell cautioned that any moves will be data-dependent, and he still expects meaningful inflation from tariffs. On Friday, though, FOMC Governor Waller countered that view, saying he doesn't expect tariffs to boost CPI significantly, and the Fed should consider easing rates as soon as next month rather than waiting for a sharp deterioration in the U.S. labor market. Last week's economic releases indicated signs of slowing, with U.S. retail sales falling more than expected in May, while the Labor Department's weekly jobless claims report revealed an uptick in layoffs. And manufacturing activity in the Northeast U.S. showed little improvement this month, according to the Fed's regional surveys. Home builder confidence fell to the lowest level in 2.5 years, with buyers stymied by high mortgage rates and economic uncertainty. Permits for future home construction of single-family homes dropped 2.7% in May. Overseas, the Bank of Japan left its benchmark rate unchanged, while moving to slow the pace of reduction in bond purchases to keep long-term rates from rising too quickly. Japan's government also plans to reduce sales of ultra-long bonds more than initially planned to soothe investor concerns. The country's core inflation reached a 2-year high last month, keeping pressure on the central bank to raise short-term rates despite risks from U.S. trade policy. In China, retail sales jumped 6.4% year over year in May, but industrial production and fixed asset investment missed expectations as the real estate slump continued. The Bank of England held rates steady at 4.25% with a closer than expected vote that left the door open to a cut in August. British inflation cooled last month to an annualized 3.4%, while services CPI dropped to 4.7% from 5.4%. Retail sales in the UK plunged 2.7% month over month and 1.3% year over year in May, dimming prospects for economic growth. And one last data point that we're going to start to add every week. As of Monday, June 23rd, 2025, the estimated price-to-earnings ratio for the S&P 500 in the U.S. was 24.46, almost 25. The forward estimated PE ratio was 21.76, so almost 22, and that's hovering near historical trends. So let's get going into our content for this week. We've talked in multiple weeks about what total return investing means, comparing total return investing to dividend investing, which is a popular thing in podcast land. We've also talked about the tax treatment of total return investing. And then last week, just a week ago, we talked about aggregation, right? Or asset aggregation, bringing together accounts that are from different places, different custodians, perhaps different account types, hopefully with different holdings, and looking at all of those accounts, those holdings as one investment plan. Now, in the book, The Life Cycle of Wealth, that I wrote a little over 10 years ago, that's getting re-released this year in August, it'll be on bookshelves about then. You can pick it up online right now from our sponsor's website. That's fideiradvice.com/lifecycle. There's a chapter there. Again, I'll repeat the website, fideiradvice.com/lifecycle. There's a chapter there called Optimize Your Assets. And this is also going to be available in a 5-part white paper series that preceded that chapter at stewardsview.com. And this dates back about the same 10-year time period. So I believe it was 2013. That's even more than 10 years ago. And so I look at that as kind of a blueprint, okay, for what my own master's work was, the thesis that I did to finish the Master's of Science in Finance. And it goes like this. We made the statement in the last session, and Chaz picked a return of 10% as an example. And I made the comment, well, not all 10% returns are created equally. So when we talk about consistency investing, the idea there, as we've talked about in weeks past, is to fund goals as efficiently as possible in any market environment. And there's a couple of different key considerations that come into play with any investment, but particularly when we're arguing for a consistent result, a risk-adjusted result. And we're going to get into an example here in a moment. And one is the risk profile of the people that are investing. And the second thing is what the plan requires. So if the plan requires 8%, but the risk profile of the people investing is, can handle 9 or 10 in risk associated, then we have to make a decision. But let's just recognize that consistency investing supports plans, funding goals in plans. And the reason for consistency investing is to do that goal funding as efficiently as possible. Okay, so let's go to an example. When we say that not all 10% returns are created equally, I'm going to go out to our sponsor's website, go to fideiradvice.com/models. And out there, I'm going to click on model 5. When I look at that particular model, I'm going to get a sense of the history of how things have gone. Now, these are examples. The question comes up, are these composites? The answer is no. Composites are coming. Composites are a lot of work. They're also, at least to this point, they haven't been essential for our sponsors' work for Fideira Advisors. But let's just take the example anyway. We look backward. These are global models, roughly 15 asset classes in 20 different asset managers, between 15 and 25, but I'm going with the midpoint. So I've got this global mix of assets and a global benchmark that's highly correlated. And that's a whole conversation by itself that I will touch on in future weeks. However, backward looking, after all fees, underlying manager costs, and costs from the advisory firm, both, the return in this example that was kept by investors was 9.3% over the past 5 years. Not a linear 9.3, not 9.3, 9.3, 9.3, 9.3, 9.3, but 2, 15, negative 5, 20, 5, 8, etc. So we have this randomness of returns, okay? The risk score associated with that particular return, that return average over the last 5 years in this example was 18.5. Now, our model at Fideira did show in this example a beat on return, and that's wonderful. I want that as much as possible. But for the case of this conversation, let's just assume that model matched up exactly with the return of the index or what the global marketplace offered. 9.3. Okay. Chaz said 10, so sorry, Chaz. We're going to go with 9.3. The risk score associated with our model was 15. Well, okay. That sounds really good. So I took my risk score down from 18.5 to 15. My return's the same, right? After all fees. So who wouldn't want the lower risk? I mean, that's an obvious statement to make. Do you want to lower your risk 15 or 20%? Yes. But here's when it really counts, is when we say, okay, well, the plan required 9, we made the 9%. The risk investor's profile would handle a 9 to 10% return. We're right in that zone. Great. So everything is lining up with the plan. But 1 year out of 5, historically speaking, in the past century, we have a bear market. Okay, so what happens to the $1 million that's invested that has an 18.5% risk score a year from now, if we're in a bear market during that period? It's worth 18.5% less, right? So compare that to 15% less. Clearly, you'd want just 15% less. But if we apply the math to that, now, 3% difference, 3.5 even, in downside value during that bear market in this example, and that's our average. It's not a linear thing either, just like the return. But for the sake of conversation, that 3.5% better off score on risk. What risk? All risk. This is standard deviation. We'll come back to that. On $1 million, that 3.5 in difference is $35,000. Okay, so would you rather have $35,000 more in a bear market or not? Well, of course you would. So the trouble comes when you're actually looking at this and evaluating this after investing. And, you've seen all the things that I'm talking about, maybe gone to our website, maybe you've, looked at other firms, you've gone through this process of evaluating firms. But a year from now, you don't unfortunately get to see most of the time what the benchmark did in the way of risk. You might get to see it, in a quarter or a year, but a rolling basis like this is pretty tough to find. So hopefully you do, but I just want to mention that up front, you've got to make this decision. So I'll leave it there for now. When we come back, let's talk about the real conversations that happen with this, and we'll take a break and do that. In the middle of a steward's view, I'm so glad we could add Dan Rushline. He is coming to us from Isle, Minnesota. Is that right, Dan?
I'm actually in Princeton right now, but Rural Music Ministries is definitely based out of Isle, so you're half right there.
Okay, you're in Princeton, and you're here to talk about Rural Music Festival, which I've told you is near and dear to my heart. It's an experience I've had now for 3 years since you started this, and it's coming up on its 4th year here this August. So what I was hoping you could do is explain a little bit about what Rural Music Festival is, how it started, where it's at, and where you think it may be going.
Yeah, so late 2021, I met Tim in a recovery group, and I had kind of mentioned to him that I had been having a dream about throwing a Christian music festival in central Minnesota. It's something that had been recurring for me for a long time. The light bulb went on in Tim's eyes, and it was really a confirmation from a calling that he had been receiving as well. Him and Cindy were already kind of in the works of planning a small concert, Christian concert in the back of their resort on the lawn out there. And so when I told him festival, I don't necessarily think he was convinced that was a great idea, because it is a pretty big undertaking. But Tim is a man of faith, and he really encouraged me to run with it, and he jumped right on board. I jumped on his board really, but kind of pushed him into making it a little bit bigger than what he was initially planning on. So
So a little bit about how this started. I mean, you had a dream, and you shared this with a friend of yours there in that area in northern Minnesota, and his name is Tim, and his wife and he were working on something to have some music come in, big national Christian act. I think you said Big Daddy Weave originally.
The initial goal was to get Big Daddy Weave. Yep, that's
Okay.
correct.
And they didn't come because there was a death. One of the band members or the lead band
Correct.
singer
Yep.
lost
That
his
was-
brother. Okay.
That's correct. Yep, it was right towards the end of COVID, and so the cool news is that this year, the end of July here, I think on the 27th, Big Daddy Weave, Ben Fuller, and Megan Wood will all be playing. Not at the festival itself, but at a tour stop at Redemption Hill, which is our venue. So we are charging a little bit for that. We're using it as a fundraiser for the event. So
Let's explain Redemption Hill to our listeners. This is where World Music Festival takes place. This is where 12 to 15 bands is, what's the number now coming this year?
we have, I believe there's 15 on the docket. We're shooting for one more. We're kind of waiting on one last offer that we have out there, but right now it looks like 15. So.
Right. And so this festival came about early on with, the idea of kind of a backyard national act coming in, and has grown to now where you have nearly 15 acts, and that original act that didn't come showing up for a separate concert, all at Redemption Hill, just outside of Isle, Minnesota. Yes?
Yep, that's correct. Yep.
Okay.
So Redemption Hill was actually, when we realized we were having a festival, we realized we needed some more space. Redemption Hill actually used to be called Smokin' Hill. It was a VFW at one point, and then it turned into a bar. And after that, it kind of became I don't know if you would call it the drug haven of kind of Mille Lacs County. And so when that almost came up for sale at the same time as this calling was placed on our lives. And it was really kind of predetermined that we were supposed to go after and get that property. And so we bought that property, and we're in that it's not an active establishment anymore. The only thing it's used for is the festival itself. So, but we're redeeming the ground, that's for sure.
Wow. And what a blessing. What else would you like our listeners to know about this event? I mean, I've heard it's donation only. I've heard there's been some amazing things that have happened with that. What else?
Yeah, the whole call for this event was to make it accessible to everybody. So whether you're a Christian or not, we wanted everyone to feel welcome, to feel like they could get in the door without really having to put any skin in the game whatsoever. So really the whole message is bring everybody you know. Come on up for a weekend. Enjoy 15 national recording artists. Where else can you do that? We have camping on site. You never know. The Holy Spirit might just show up in someone's life who you never expected, and we've absolutely seen that. Last year on Saturday, we did over 60 baptisms and discipled over 60 people. So we're hoping that, God is going to move however God chooses to move, but we're hoping that number continues to grow. And that's the whole point of the event, is to introduce people to Jesus, show them grace, love, mercy, model for them what the Christian community and neighborhood is actually like. So we just want to get everybody up there. That's the whole point of the whole thing. So
60 people.
Probably more people. We're thinking thousands of people probably have either recommitted or committed their lives for the first time. Last year we had over 18,000 people over the course of the 3 days. So it's gotten a lot bigger than we anticipated at the beginning.
Sure.
We had about 18,000 people last year. That first year we were right between 5 and 6 over the course of. Remember, the first year we were crazy enough to do it for 4 days. So we've since scaled that back to 3. 4 is a little bit too much. For the volunteers and the sake of everyone who's trying to make sure that the logistics of the thing keep functioning, 4 days is too much time. So,
Well, it's a remarkable event. And where can everybody go to learn more about it?
yeah, ruralmusic.org. So rural music, RURAL music.org. Check us out online. We'd love to see you come and spend your weekend with us. If you're interested in volunteering, we're always looking for help. If none of those things pique your interest, prayer. We need a lot of prayer.
Dan, this has been so delightful to have you on the program. Thank you for joining us. We've been talking with Dan Rushline from Rural Music Festival, one of the founders of that event. It's now a national event, and I'm going to say that because I've attended all 3 years, and I've seen people from all over the country come to this. And so that's coming up. The dates again, Dan?
Oh, man. August 22nd through August 24th.
Okay. So check it out, ruralmusic.org. Dan Rushline, thank you.
Thanks so much. Appreciate your input.
You bet. And we're back. So we talked in the first segment about consistency investing. We talked about why it matters. I gave you an example of what happens when a risk score is lower and how our capital doesn't deplete as much. And by the way, that allows us to come back faster. And that's been a discussion in previous sessions. So with that, if you are sitting out a year from now and we've had a bear market and you're looking at, $1 million minus 15%, you've now got $850,000. And so that doesn't feel very good. But if our return average is 9, let's look at it. 9 plus 15, 9 minus 15. 9 plus 15 is 24. 9 minus 15 is negative 6. Somewhere between normally negative 6 and positive 24. So if the bear actually took me down that far, what can I expect? I can expect that I will end up between a negative 6 and a positive 24, 2/3 of the time. In fact, what I can also say is if I add one more risk score of 15 to the negative 6 and the positive 24, this is the bell curve right from college, then I'm going to end up with a negative 21. Or I can end up with, 24 plus 15, end of the day here, 39. So I could be at anywhere from negative, 24 to positive 39. That's 2 deviations or 2 risk factors away from my average of 9. All right, so I just said that in this example, I closed the year at 850 from $1 million. Well, there's a 95% chance that I'll be 2 risk factors between the 2 risk factors or data points of negative 20 something and positive 29 in the next year. Okay, that's a reason for continuing to invest. If I take that 15 though, and I make it 18.5, and then I double 18.5, you could start to see where that 18.5 times 2, that's 36, 37 from 9. Boy, I could be down to negative, 28 in a given year. That's 95% of my possibilities. Most investors can't stomach that. That would have been a 2022 scenario, by the way. 2008, we had 3 deviations or risk factors away from average returns. And the average return of the S&P 500, by the way, is about 10% with dividends reinvested and gains reinvested. So these risk scores really matter as far as the spread of returns. And so the key here is to get to the end, especially the tough years, and go, okay, well, I'm down, but how much risk did I actually take on the way down? And therefore, how fast can I expect to come back? Right? And especially when you're taking withdrawals from your assets, we can talk about that in a future session. This becomes a really valuable conversation. So there's a guy, I'll leave it with this. There's a professor, still alive to my knowledge, named William Sharp, that put these 2 things together. He put together mean return and standard deviation. And it's called the Sharpe ratio. And it basically says, for the risks that you took, how much excess return did you get? Okay, so Fiduciary advisors will track a 3, 5, even a 10-year Sharpe ratio after fees. We could do it before, but we typically do it after fees, which is incorporating return and risk. And particularly when those bear markets come, this is a very important metric to be aware of. In future weeks, I would like to touch on what we'll loosely call an MVO or an MVA score, mean variance optimization. And I hesitate to go there, but this program is meant to equip listeners who are dealing with at least an asset base of $1 million, right? And so I want to make sure that group is as informed as possible. Okay, so we talked about the Sharpe ratio. We talked about what's included in it, which is a mean return after fees and a standard deviation. Standard deviation, by the way, is just market return and business return combined. There are other variance-based measures like the bell curve from college Sortino ratio, information ratio, things like that. But standard deviation is widely published, and so is the Sharpe ratio. So we're using those. Okay. So I want to land this plane, but what we're trying to do here is describe when we have volatility around us, we have slowing growth and volatility like we do right now, when we have a changing picture like we do in 2025 with tariffs and geopolitical conflicts and things that are new, data points and chaos, getting a consistent return is all the more important, right? Shrinking the range of returns, the actual returns around the average. That's what this is about. So we can't do that if we haven't aggregated. We can't do good tax planning with it if we don't have an understanding of what the tax consequences are, the various account types that we're combining. And we definitely can't do this if we're just out listening to the latest, dividend investing idea. So let's zoom out. Let's look at what's happening in the week ahead. But at least we get an idea from this session, I hope, of what consistency investing is about and why it matters. Okay, so looking at the week ahead. While the world anxiously awaits developments in the Middle East now that the U.S. has become involved, a busy week of economic data and Fed speak is on tap. First up are today's global flash PMI releases. Business sentiment sank earlier this year due to escalating trade wars, but bright spots have emerged in developed countries, specifically in U.S. services and Eurozone manufacturing. Although consumer price pressures have remained subdued, the recent spike in oil prices and slowing spending trends from U.S. consumers will put Friday's core PCE price index report in focus. And now that the Fed's quiet period has ended, there will be numerous appearances from committee members this week to expand on monetary policy thoughts. Chairman Powell's two-day testimony before Congress begins on Tuesday. The rest of the domestic economic calendar includes housing data, consumer confidence, trade balance figures, and a revised consumer sentiment reading. A few corporate earnings announcements to note throughout the week are General Mills, KB Home, Micron Technology, and Nike. On the international agenda, in addition to flash PMI releases, there are inflation updates in Canada, Japan, and Australia, along with business and consumer sentiment surveys from Germany. So lots happening in this week that we're now in. With that, it's been such a pleasure to be back with you. I do hope this session has been a benefit to you and others you decide to share it with. We invite you to connect with us online at astewardsview.com. You can also schedule with our sponsor, Fidere Advisors, in the footer of that website. That's astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidere Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.